You think watching the market closer gives you more control. That's the lie that's quietly bleeding your account day after day, and it's time you understood exactly why. Here's the brutal truth you don't want to admit yet. You're not trading the market. You're trading your own anxiety. You sit there with your 1-minute chart open, maybe the 5-minute on another screen, red and green candles flashing like a slot machine. Every tiny spike makes your heart rate jump. Every small dip makes your mouse hand twitch. It feels like you're doing real work, like you're in tune with the market. But what you're actually doing is amplifying randomness until it becomes indistinguishable from signal. 95% of retail traders lose money, and it's not because they're all stupid or lazy. Many study hard. They know the patterns, understand the terminology, watch the same educational content you do. They still lose because they drown themselves in noise. They confuse constant data with actual information. They mistake motion for edge. They fall victim to what I call the microscope fallacy, the belief that zooming in gives you precision when it actually gives you chaos. Let me show you what's really happening to your account. You wake up at market open with a plan. You've done your homework, identified your levels, know what you're looking for. But then you open your charting platform, and those 5-minute bars start painting. A stock gaps up. You see a quick pullback. Your finger hovers over the buy button. The candle turns green. You're in. 30 seconds later, it reverses. Your stop triggers. Loss number 1. It's 9:35 in the morning. By 10 o'clock, you've taken 4 more trades, 2 small wins, 2 more losses. You're down $140, but more importantly, you're exhausted. Your cortisol is spiking. Your decision-making is already compromised, and you have 6 more hours of market action ahead of you. This is the microscope fallacy in real time. You believe that seeing every tick, every minor fluctuation, every 2-minute consolidation gives you an advantage. But what you're actually doing is volunteering to be liquidity for bigger players who are operating on entirely different time frames. The amateur identity is built on that addiction to stimulation. He feels uneasy when nothing is happening. He opens 6 time frames, 8 indicators, 3 news feeds. He thinks if he can see everything, he can control something. The professional is the opposite. He's trying to see as little as possible, as clearly as possible. He's not looking for excitement. He's looking for signal. He understands that his primary job isn't finding trades, it's managing his own state so he can execute well when the right trade appears. Jesse Livermore understood this principle over a century ago. The boy plunger made millions without a single 1-minute chart. He didn't even have candlesticks like you do. He had the tape, just prices printing, tick by tick, and his job was to wait. Not for every fluctuation, but for what he called pivotal points. Moments where the market shifts character, where resistance that held for days finally breaks and stays broken, where weakness stops making new lows and starts finding support. If you gave Livermore your modern platform, you know what he wouldn't do? He wouldn't stare at every tick. He would find the time frame that shows him the line of least resistance without the static. That's what the 1-hour chart actually is. It's not slow, it's clean. One candle represents 60 minutes of fighting, bargaining, fear, greed, algorithms, news, and human emotion compressed into a single vote. Each bar answers a simple question. Did the buyers win this hour, or did the sellers? Here's what you're actually looking at on different time frames. On lower time frames, you're watching the nervous system of the market. Tiny reflexes, algorithmic twitching, market makers probing liquidity for pennies, retail traders reacting to headlines they don't understand, high-frequency trading firms creating fake breakouts to trigger your stop losses. It's like putting a microphone against someone's skull and trying to read their mind based on random electrical noise. On the 1-hour chart, you're looking at the circulatory system instead. You're watching where real blood flows. Funds allocating capital. Large players building and unloading positions over hours and days. A pension fund doesn't buy $10 million worth of stock in 3 minutes. They accumulate over sessions, building positions across multiple hours, sometimes multiple days. Their footprints show up on hourly bars. Their intentions become readable when you step back from the chaos. Your time frame is your very first risk filter. Before you think about position size, before you obsess over your stop-loss placement, before you pick an exact entry, You've already taken or refused a massive amount of risk with just one decision: what time frame you choose to believe. If you choose the 1-minute chart, you are choosing to participate in every fake breakout, every stop hunt, every headline spike. You're volunteering to feel everything the market does, no matter how meaningless. If you choose the 1-hour chart, you are choosing to let all that play out in the background and only respond when the dust settles. That simple shift eliminates a massive percentage of bad trades before you're even tempted to take them. Think about your own last month of trading. Imagine you were only allowed to take trades that made sense on the 1-hour chart. How many of your worst scalps would never have happened? That revenge trade, because you were angry at the previous candle? Gone. That breakout you bought on a tiny push above a level that had been tested 20 times already? Filtered out. The 1-hour chart gives you permission to be patient. It gives you permission to wait for the setup that matters. It gives you permission to ignore the 100 small moves that don't matter and focus on the 3 big moves that do. When every candle feels like life or death, your nervous system never gets to stand down. You are constantly in fight or flight. A brain in fight or flight is not capable of rational position sizing, disciplined stop placement, or patient waiting. Professionals understand that waiting is a position. Livermore said it best: "It was never my thinking that made the big money for me. It was always my sitting." The ability to sit tight, to do nothing, to let the market come to you instead of chasing every shadow. That's the skill that separates the 5% who win from the 95% who lose. In this video, we're going to expose why the 1-hour chart quietly outperforms frantic scalping. We're going to show you how Livermore's principles map perfectly to hourly bars. We're going to give you 3 ironclad rules that make overtrading nearly impossible. Because here's the paradox that will save your account: doing less on a slower chart can triple your profit and eliminate your stress. You don't need more trades. You don't need more screen time. You need fewer, better decisions. You need to trade when the odds are genuinely in your favor, not when you're bored or anxious or trying to make back yesterday's losses. Next, we'll start with the hidden tax that's eating your gains alive, and it's not commissions. It's something far more insidious, something that compounds with every frantic click, every unnecessary order, every overtrade. A tax that doesn't show up on your broker's statement as a line item, but drains your equity all the same. And when you see it laid out in numbers, you'll understand why the 1-hour chart isn't just cleaner. It's cheaper, calmer, and the only time frame that makes sense if you're serious about surviving long enough to actually compound your money. Every trade you take costs you money, even when you break even. That's the brutal truth most traders refuse to face. You see a flat P&L and tell yourself no harm was done. But that's a lie. There is always harm. There are always costs. And most traders never bother to calculate the real price of their addiction to action. There are 2 types of costs bleeding your account. The first is obvious: commissions, spreads, slippage. The second is invisible and far more dangerous: decision fatigue. Your ability to think clearly, to follow your plan, to resist impulse. This is the hidden tax of hyperactive trading, and it compounds with every click of your mouse. Let me show you with real numbers, because numbers don't lie even when your emotions do. Meet Sarah, a trader I coached last year. When she first contacted me, she was proud of her work ethic. She was grinding every day on 5-minute charts, scalping every move that looked remotely interesting. 18 trades per day on average. She kept meticulous records. Win rate, 54%. On paper, that sounds decent. More wins than losses. Technically profitable. But there was a problem she couldn't see. After 4 months of disciplined trading, she was down $12,000. Her equity curve was sliding downward, drip by drip. Nothing dramatic, nothing that triggered panic, just a slow bleed that confused and frustrated her. Her reaction was typical: "I just need to refine my entries a bit." She thought the problem was her strategy. It wasn't. It was her frequency. So we did the math together. The math that nobody wants to do. 18 trades per day. Round-trip commissions and fees averaged $8 per trade. That's $144 per day, just to participate in the market. Not to win, not to profit, just to press the buy and sell buttons. Multiply that by 260 trading days in a year, and you get an annual friction cost of $37,440. Let that number sink in. Before Sarah made a single dollar for herself, she had to generate nearly $40,000 just to pay the toll. Her broker was getting rich while she was getting poor. And that's not even counting the bid-ask spread she paid on every entry and exit, or the slippage when she used market orders during volatile moments. When we calculated what she needed to earn per trade just to break even, the number was shocking: $208 per trade. Every time she made $150 and felt like a winner, she was actually losing $58 after friction costs. She wasn't trading the market. She was working for her broker. But the visible costs were only half the problem. The invisible tax was even worse. Every time Sarah took a trade, she spent mental energy. She had to evaluate the setup, choose her entry, manage the position, decide when to exit, then process the emotional outcome. Do that 18 times in a day and see what's left of your decision-making ability by lunch. Think of your brain as a battery. You start each day with a full charge of willpower and analytical capability. Every choice drains that battery a little. When it's full, you can follow your plan, respect your stops, wait for confirmation. But as the day wears on and the decisions pile up, something shifts. Your patience thins. Your tolerance for waiting shrinks. You start forcing trades you wouldn't have taken in the morning. What you call lack of discipline is often just a depleted battery. You spent your decision-making power on marginal setups, and when a genuine opportunity finally appeared, you were too mentally exhausted to execute properly. By trade number 15, your brain is measurably worse at risk assessment than it was at trade number 1. You're tired, emotional, reactive instead of responsive. So we changed one variable for Sarah, time frame. We moved her from 5-minute charts to 1-hour charts. Same markets, same basic strategy, same risk management principles. The only difference was the speed of the game. Her trade frequency dropped immediately to 3 trades per day, not because we imposed some arbitrary limit, but because the 1-hour chart simply doesn't offer 18 high-probability setups in a single session. The results were immediate and dramatic. Her visible friction costs collapsed from $144 per day to $24. Her annual tax dropped from $37,000 to just over $6,000. She cut her hidden tax by 83% without changing anything else about her approach. But something more important happened. Her win rate climbed from 54% to 61%. Not because she suddenly developed new skills, but because she was only taking high-conviction setups. When you can only see 3 or 4 real opportunities per day instead of 30, you become selective. You wait for confirmation. You respect the setup. You stop forcing trades just to feel productive. The net result over the next 4 months: $18,000 in profit. Same person, same strategy, different time frame. The 1-hour chart had imposed a natural speed limit that saved her from herself. This is what the 1-hour chart does. It physically limits your ability to overtrade. There are only 24 bars in a trading day. You cannot force 18 trades when opportunities are constrained by time itself. You're locked out by the rhythm of the market. The chart forces you to wait, to be patient, to sit on your hands while the current candle develops. Livermore understood this principle over a century ago when he said, "It was never my thinking that made the big money for me. It was always my sitting." The 1-hour chart makes sitting easier because it removes the temptation to act on every minor fluctuation. When the next candle won't form for another 47 minutes, you can't act impulsively. You're protected from yourself by time. But here's the psychological trap you must prepare for. When you slow down, your brain will rebel. You'll feel lazy, unproductive, like you're missing opportunities. You'll see other traders posting screenshots of 10 trades before noon and feel like you're not doing enough. This is your amateur self screaming, the part of you that equates activity with progress. That voice will try to sabotage your professional evolution. It will whisper that you should check the 5-minute chart, just to see what's happening. It will suggest opening another position because you're not doing anything with this slow-moving hourly candle. If you listen to it, it will destroy your edge every single time. Here's your protocol. Go back through your last month of trading. Count your total trades and calculate your average daily frequency. Then multiply that by your average cost per trade, including commissions, spreads, and slippage. That number represents the hidden tax on your impatience. For most active traders, it's a shocking figure. Project it annually and you'll see exactly what your need for action is costing you. The 1-hour chart cuts this tax by 70 to 80%, while simultaneously improving your win rate. It preserves your mental capital for the decisions that actually matter. It transforms you from a volume generator feeding your broker into a selective professional feeding your own account. Frequency is the enemy of profit. Patience is the partner of wealth. Next, we'll dive into the technical superiority of hourly bars and why they reveal what institutions are actually doing while you're busy chasing 5-minute noise. Markets don't move because 10 retail traders hit buy on a 5-minute breakout. They move because pension funds shift $500 million over 3 hours. They move because sovereign wealth funds rebalance portfolios worth billions. They move because the entities that actually own the market are making decisions that unfold over hours and days, not seconds and minutes. When you trade lower time frames, you're trying to front-run ghosts. You're reacting to algorithmic noise, retail panic, and market maker inventory adjustments. You're reading ripples on the surface while completely missing the current underneath. When you trade the 1-hour chart, you're finally aligning yourself with the players who have the capital to sustain trends. You're watching where real money flows, and real money doesn't move on 5-minute impulses. Let me show you exactly what this looks like with a concrete example that happens every week in markets. Picture a stock that's been capped at $75 for 2 weeks. Every time it approaches that level, sellers appear. It touches 75 and drops back. This level has become psychologically significant. Traders mark it on their charts, set alerts, plan their strategies around it. Now watch what happens on the 5-minute chart. You see dozens of attempts to break through. Little pokes above 75, maybe reaching 75.20 or 75.30, then immediately reversing. Each spike looks like the breakout. Each one triggers by orders from eager traders who think this is finally the moment. And each one fails, stopping them out within minutes. The amateur gets conditioned by these fake breakouts. He starts believing 75 is unbreakable. When the real move finally happens, he's either too scared to take it or positioned on the wrong side, trying to fade what he thinks is just another false break. But look at the same price action on the 1-hour chart. All those failed breakouts, all that noise, all those stop hunts, they're just wicks within hourly candles. They're minor fluctuations that don't even register as significant on the hourly time frame. The 1-hour chart tells a completely different story. 75 is being tested, but it hasn't actually broken in any meaningful way. Not yet. Then one morning, something fundamental changes. A 1-hour candle closes decisively above 75 on heavy volume. Not a wick, not a quick spike that reverses, but a solid close at 75.80 with real participation. That required sustained buying pressure over 60 minutes. That's not retail traders gambling on a breakout. That's institutional money making a statement. The next hour, price dips back to test 75. The amateur sees this pullback and panics. He thinks the breakout failed. He might even short it, convinced it's heading back to 72. But watch what happens. Price touches 75 and holds. It doesn't slice back through. It doesn't trigger a cascade of selling. It finds support exactly where resistance used to be. Buyers step in at the level where sellers dominated for 2 weeks. This is a pivotal point. This is what Livermore meant by the line of least resistance flipping. The character of the market just changed fundamentally. What was a ceiling became a floor. The amateur fights this reality. It's overbought. I'm shorting. The professional respects the new structure. Resistance became support. I'm buying the retest. Here's why the 1-hour chart reveals institutional activity, while lower time frames hide it behind noise. 3 critical factors make the difference. First, volume concentration. It takes significant money to paint a 1-hour candle that closes beyond a major level. Think about what has to happen for price to move from 75 to 76 and hold there for an entire hour. Thousands of shares have to be absorbed at every price level. Sellers between those 2 points have to be overwhelmed by consistent buying. Random retail orders can't sustain that kind of momentum. A few scalpers can't create that kind of structural change. When you see a strong hourly close with volume, you're seeing institutional footprints. Someone with real capital made a real decision to build a position they intend to hold for days or weeks. Second, the time factor. Institutions cannot operate on 5-minute timeframes. They're physically constrained by position size. If a pension fund needs to deploy $50 million into a stock, they can't market buy it all in one burst without moving the price against themselves and creating massive slippage. Instead, they accumulate methodically over hours, sometimes days. They buy into weakness, build positions gradually, and their activity creates the structured patterns you see in hourly bars. When you observe a stock grinding higher on the 1-hour chart, making higher lows, respecting support levels, that's not retail enthusiasm. That's methodical accumulation by someone with deep pockets. Third, noise filtering. The 1-hour time frame acts like noise-canceling headphones for your trading. It smooths out all the chaos that dominates lower charts. Algorithmic chop, high-frequency trading battles, emotional retail reactions to headlines, stop hunts designed to trigger your orders before reversing. All of that gets filtered out. What remains is the genuine directional bias of the market, the actual supply and demand dynamic playing out over meaningful time periods. A single headline might create a 3% spike on the 5-minute chart that reverses in 10 minutes, but on the 1-hour chart, that entire event becomes just a wick. The hourly bar tells you whether that spike was absorbed or rejected, whether it represented a real shift or just temporary noise. So here's your protocol for identifying and trading 1-hour pivotal points. This isn't theory. This is a systematic approach that aligns you with institutional money flow. Start by marking obvious 1-hour swing highs and lows that have held for multiple sessions. These aren't arbitrary lines. They're levels where supply and demand have battled before, and one side established dominance. In our example, $75 became significant because it repeatedly acted as resistance. The market has memory at these levels. Next, wait for decisive breaks. Not wicks, not quick spikes, but strong 1-hour closes beyond the level with volume confirmation. You want to see the candle body, not just the wick, trading beyond your marked level. If 75 was resistance, you need a 1-hour close at 75.50 or higher, ideally on volume above recent averages. This is your signal that the character changed, that institutions stepped in with conviction. Then comes the critical part. Look for the retest. Most real breakouts will pull back to test the broken level before continuing. This retest is your gift. It's the market giving you a second chance to enter at a better price with a tighter stop. The amateur already bought the initial breakout and is now panicking during the pullback. The professional waited for confirmation and is now entering the retest with conviction, knowing the level should hold as new support. Enter near successful retests with your stop just beyond the pivotal level. If 75 held as new support, you buy near 75 with your stop at 74.70. You're risking 30 cents to potentially capture several dollars if the institutional flow continues. Your risk-reward is defined by the structure the big players created with their capital. This approach works because you're not predicting. You're responding. You're not guessing where institutions will act. You're observing where they already acted and aligning yourself with their demonstrated intent. You're trading the current, not the ripples. The 1-hour chart shows you where the river flows. The amateur chases every surface disturbance. He sees movement and assumes opportunity. He trades the noise because he can't distinguish it from signal. The professional waits for the wave that matters. He lets 100 small moves pass without regret, because he knows one big institutional move will compensate for all that patience. Next, we'll cover the 3 ironclad rules that make 1-hour trading nearly foolproof. These aren't suggestions, they're laws. Break even one of them, and you turn yourself back into an amateur, no matter how well you understand pivotal points or institutional footprints. These 3 rules separate professionals from amateurs. Break even one, and you're back to gambling. You can master chart patterns, understand market structure, develop perfect risk management, but violate these laws and the market will still treat you like a tourist feeding coins into a slot machine. These aren't suggestions. They aren't guidelines you can bend when it feels convenient. They are laws. Non-negotiable principles that protect you from your own worst impulses and align you with the rhythm of institutional money. Follow all three, and you create a framework that's nearly impossible to violate. Ignore even one, and you're back to hoping instead of trading. Never execute a trade based on the 1-hour chart until the candle has officially closed. If the setup looks absolutely perfect at 10:45 in the morning, you do nothing. You sit on your hands. You wait until 11 o'clock. No exceptions. No special circumstances. No just this once, because it's so obvious. Why does this matter so profoundly? Because the last 15 minutes of an hourly candle can completely erase the first 45 minutes of price action. You've witnessed this destruction firsthand. A stock rallies beautifully for 3/4 of the hour, painting what appears to be a perfect bullish engulfing candle. You're watching it in real time, calculating position size, identifying your stop, visualizing the profit target. Your finger hovers over the buy button at 10:58 because you're terrified of missing the move. Then in the final 2 minutes, everything changes. Heavy volume hits the offer. Institutional selling appears. By the time 11 o'clock strikes, what looked like a bullish reversal has become a shooting star with a massive upper wick. The candle closed near its low, not its high. If you bought at 10:58, you're immediately underwater with your thesis invalidated before you even had time to process what happened. This requires immense discipline because you will watch price moving without you. You will see what appears to be the perfect entry developing. FOMO will claw at your chest. Your amateur self will scream that you're missing the move, that by the time the candle closes it will be too late, that you need to act now while the momentum is strong. The amateur thinks, I have to get in now or I'll miss it. The professional thinks, I need confirmation that buyers are actually in control for the full hour. This difference in mindset separates gambling from trading. The amateur wants to predict what will happen. The professional wants to respond to what actually happened. Here's the mathematical edge this discipline provides. On a 5-minute chart, you have 12 candles per hour. That's 12 decision points, 12 opportunities to be right or wrong, 12 moments where your emotions can override your plan. On the 1-hour chart, you have exactly one decision per hour. You reduce your decision fatigue by 1100%. Your mental capital is preserved. Your emotional battery stays charged. When that one decision point arrives, you're fresh and capable of following your process instead of reacting from exhaustion. Before you take any 1-hour setup, you must check the daily chart. This is your permission slip. The daily chart tells you where institutional money is positioned. The 1-hour chart tells you when they're actively moving. When both align, you have maximum edge. When they conflict, you have maximum risk. Think of the daily chart as the tide, and the 1-hour chart as the waves. You can surf a wave in either direction, but if you fight the tide, your odds of being dragged under increase dramatically. If the daily shows an uptrend and your 1-hour shows a bullish pivot, you're trading with the current. You have institutional flow behind you. Even if your entry isn't perfect, the momentum of the larger trend can carry you to profitability. If the daily is clearly bearish and your 1-hour chart flashes a bullish setup, you're fighting institutional flow. You're betting that you, with your small account and emotional biases, can outsmart funds deploying hundreds of millions based on macro fundamentals and long-term positioning. That's not trading. That's ego. Here's how this looks in practice. A stock has been in a daily uptrend for weeks, making steady higher highs and higher lows, riding comfortably above its 20-day moving average. Then it pulls back, which is normal and healthy in any uptrend. On the 1-hour chart, you watch it decline to the 20-period moving average. This level has acted as support multiple times during the uptrend. Price reaches that level and forms a hammer candle, long lower wick, small body near the top, showing that sellers pushed price down, but buyers rejected the low and pushed it back up by the close. The next 1-hour candle opens higher than the hammer closed and continues climbing. It closes decisively above the hammer's high. This is your confirmation. The retest of support was successful. Buyers defended the level aggressively. The uptrend is resuming. But here's the critical point. This setup only has real edge because you're aligned with the daily trend. The identical hammer candle at the same moving average in a daily downtrend would be a trap. You'd be trying to catch a falling knife, hoping for a bounce that might last a few hours before the dominant bearish pressure reasserts itself. The professional always asks, am I trading with the institutional flow or against it? When the daily says up and the 1 hour confirms up, you have permission to be aggressive. When they disagree, you have permission to walk away. The 1 hour chart gives you roughly 8 to 10 tradable hours in a standard market session. During those hours, maybe 3 or 4 legitimate setups will form according to your criteria. You don't need to take all of them. You don't need half of them. You need one perfect trade. One setup where all your conditions align, where the risk-reward is crystal clear, where the probability is genuinely in your favor. Most traders feel unproductive if they aren't clicking buttons. They treat trading like a video game where high activity equals a high score. But in trading, activity is often inversely correlated with profitability. The more you trade, the more you pay in friction costs, the more you risk slippage, and the more likely you are to make an emotional error when your decision-making battery runs low. Your job is to act like a sniper, not a machine gunner. You scan for your specific setup, breakout, retest, pivotal point, whatever your strategy focuses on. You wait for it to develop properly. You wait for the candle to close. You verify daily trend alignment. If everything checks out, you execute without hesitation. If it doesn't happen, you close the platform and preserve your capital. There is no shame in a day with 0 trades. There is enormous shame in forcing a trade just to feel busy. Let me show you what this transformation looks like. Tom was a student who came to me after a year of consistent losses. He understood technical analysis, followed the markets religiously, but he was bleeding money month after month. When we examined his trading logs, the problem became obvious. He was taking 6 to 8 trades every single day, all on lower time frames. He was catching the morning gap, giving it back during lunch chop, fighting the afternoon drift, and revenge trading into the close. He was exhausted and unprofitable. We implemented the 3 laws. No entries until the 1 hour candle closed. No trades against the daily trend. Maximum 2 trades per day, period. That was it. No new indicators, no magic system, no complex strategies. Just constraints. The first week was psychological torture for him. He felt bored. He felt unproductive. He felt like he was missing opportunities everywhere. But then he looked at his results. His trade frequency dropped to an average of 1.5 trades per day. Some days he took 2 trades. Many days he took 1. Some days he took 0. But his win rate jumped from 48% to 67%. Not because he developed new skills overnight, but because he stopped taking low probability setups. He stopped trading boredom, anxiety, and FOMO. He started trading probability. Within 6 weeks, he was consistently profitable for the first time in his trading career. The market didn't change. His edge didn't become magical. He simply stopped bleeding from self-inflicted wounds. 1 perfect trade beats 10 mediocre ones. This maxim should be burned into your consciousness. Quality over quantity isn't a nice philosophical idea. It's the fundamental principle that separates professionals from amateurs. The amateur measures his day by how many trades he took. The professional measures his day by whether he followed his process and took only the setups that met his criteria. These 3 laws create a framework that's nearly impossible to violate if you commit to them completely. You're no longer guessing. You're not hoping or predicting or gambling on incomplete information. You're executing a repeatable process built on probability, structure, and alignment with institutional money flow. You wait for confirmation. You align with the bigger picture. You take only the highest conviction setups. Everything else is noise you're choosing to ignore. The beauty of this framework is that it protects you from yourself. Your discipline doesn't need to be superhuman because the structure does most of the work. When you can only make 1 decision per hour, and that decision must align with the daily trend, and you're only looking for 1 perfect setup per session, there's very little room for emotional trading. The laws act as guardrails that keep you on the road even when your emotions try to drive you off the cliff. But catching the right setup is only half the battle. The real money, the Livermore money, is made in how you handle the trade once you're in profit. Next, we'll see exactly how this plays out with position sizing and the lost art of pyramiding. This is Jesse Livermore's secret weapon for turning small wins into fortune-building campaigns, and it maps perfectly to the 1-hour time frame structure we've been building. When you move to the 1-hour chart, you must accept that the entire game has changed. You cannot bring scalper habits into a swing environment and expect to survive. Those tight 10-cent stops you relied on for 1-minute charts have no place here. The market needs room to breathe. Institutional money requires space to develop positions over hours, not minutes. If you try to impose scalping parameters on hourly structure, you will be shaken out of every valid setup before it has a chance to work. This fundamental shift brings us to the mathematics of proper position sizing, a concept most traders ignore until they've destroyed their first account. The relationship is inverse and non-negotiable. As your stop loss widens to accommodate 1-hour structure, your position size must shrink to maintain identical dollar risk. This is where your ego takes the first hit. Here's the precise math that governs this transformation. Let's say your risk per trade is $500. That's your line in the sand, your maximum acceptable loss on any single position. On a 5-minute chart, your stop might be 50 cents away from entry. To risk $500 with a 50-cent stop, you buy 1,000 shares. Simple calculation. 1,000 shares times 50 cents equals $500 of risk. Now you move to the 1-hour chart. The same setup requires a $1 stop, because hourly price action demands wider swings. The amateur sees that dollar stop and either refuses the trade entirely or buys 1,000 shares anyway, now risking $1,000 instead of $500. The professional does the math. To risk $500 with a $1 stop, he buys 500 shares. Half the position size, identical dollar risk. This is where most traders stumble psychologically. They see 500 shares instead of 1,000 and feel diminished. They feel like they're not really in the trade, like they're being too conservative, like they're leaving money on the table. This is amateur thinking disguised as ambition. You're not trading share counts. You're trading profit potential measured in points multiplied by shares. Don't fear smaller share counts. The 1-hour chart captures moves that are 3 to 5 times larger than 5-minute moves. You're trading fewer shares for substantially more points. The mathematics works in your favor if you let the move develop. But proper sizing is only survival. If you want to build real wealth like Jesse Livermore did, you need to move beyond survival into strategic aggression. This is where pyramiding becomes your secret weapon. Most traders do the exact opposite of what creates fortunes. They are terrified of winning. The moment they see green on their screen, panic sets in. They snatch profits, closing trades prematurely, satisfying their need for immediate gratification while capping their upside forever. They eat like birds and defecate like elephants, taking tiny wins and holding massive losses. Livermore flipped this script completely. He built positions as the market confirmed his thesis. He didn't just buy once and hope. He bought, waited for the market to prove him right, then bought more. He used the market's own money to finance larger positions. This transforms individual trades into military-style campaigns designed to capture entire trends, not just the first leg. Here is the systematic pyramiding protocol that maps directly to 1-hour chart structure. This isn't random adding. This is a disciplined campaign with decreasing risk as you build size. Step 1. Initial entry at the pivotal point breakout with 1% account risk. You've identified clear resistance, waited for the decisive 1-hour close beyond it, verified daily trend alignment. You enter with proper position sizing based on your stop distance. This is your probe, your way of asking the market, is this breakout legitimate? Step 2. A's price rallies and forms a higher low on the 1-hour chart, add a second unit risking 0.5% of your account. The market just answered your question affirmatively. Buyers defended a higher level than your entry. The structure is improving. You add at the retest of this new support level, but with smaller size, disciplined aggression, not reckless gambling. Step 3. Immediately trail your stop for the entire position to just below this new 1-hour support level. This is the genius of the system. You're not leaving your original stop in place. You're moving protection for all shares up to lock in gains. Your original position is now moving toward risk-free status, financed by open profits. Step 4. If another clear 1-hour pivot forms higher, consider a third unit at even smaller size. maybe 0.25% account risk. You're building a pyramid that gets smaller as it rises, with your largest exposure at the best prices near the beginning of the move. Let me show you this with concrete numbers. A stock breaks decisively above $50 resistance on strong volume. You buy 500 shares with your stop at $48. That's $2 risk per share, $1,000 total risk on a $50,000 account. Price rallies to $55 over the next few sessions. You're up $2,500 in open profit. Then comes the pullback. Price retraces to $52 and forms a clear support level on the 1-hour chart. Multiple candles test this level and hold. When price bounces strongly and closes above $52.50, you add 250 shares. Your stop for this addition is $51.50, risking $250 on the new unit. Immediately, you move your stop for all 750 shares to $51.50. Now calculate your transformed risk profile. Your original 500 shares entered at 50 and are now stopped at $51.50. Instead of risking $1,000, you're guaranteed a profit of $750 on those shares even if stopped out. Your second unit risks $250. Your total exposure on the entire position is now $250, but your profit potential has expanded dramatically because you're holding 750 shares instead of 500. This is the mathematical beauty of pyramiding. Your original position becomes risk-free, financed entirely by gains you've already captured structurally. If price continues to $60, you make $7,500 instead of $5,000. If it reaches $65, you make $9,375 instead of $7,500. You've transformed a good trade into a campaign that captures the full trend potential. The maxim that governs this entire approach is non-negotiable. Add to strength on the 1-hour chart. Never add to weakness on any time frame. The amateur averages down on losers, buying more as price moves against him, hoping to lower his average cost. This is the fastest path to bankruptcy. The professional pyramid's up on winners, using 1-hour structure as his guide. He increases exposure only when the market proves his thesis correct, by forming higher lows in uptrends or lower highs in downtrends. This approach requires patience and courage that most traders simply don't possess. You have to watch your initial position move into profit and resist the urge to take it off immediately. You have to wait for the pullback and trust that if the trend is genuine, support will hold. You have to add to a position that's already green, which feels dangerous to amateurs conditioned to fear giving back gains. But this is how you turn small wins into fortune-building campaigns. This is how you capture full trend potential instead of just the first move. This is how you align with institutional money that builds positions over days and weeks, not minutes. The 1-hour chart provides the structure to execute this systematically. The pivots are clear, the support levels obvious, the trailing stops logical. The hardest part isn't the technique. The mathematics are straightforward. The rules are clear. The real challenge is psychological. And that's what we're covering next. The final obstacle between you and consistent profitability isn't your strategy or capital or market knowledge. It's learning to embrace the silence between the candles, sitting still when every instinct screams at you to do something. That silence is where the real money is made. The hardest part of 1-hour trading isn't technical analysis. It's not identifying pivotal points, calculating position sizes, or managing stops. The real battle happens in the empty space between decisions. The hardest part is the silence. When you finally commit to this time frame, you're going to experience something that feels like physical withdrawal. You'll complete your analysis, mark your levels, maybe place a conditional order, and then check the clock. 43 minutes remaining on the current candle. 43 minutes until your next decision point. For someone conditioned by the flashing lights and constant dopamine hits of lower time frames, this silence doesn't just feel uncomfortable, it feels like professional death. Your brain has been rewired by years of constant stimulation. Social media trained you to expect new information every few seconds. Lower time frame trading reinforced that addiction, making you believe that constant activity equals competence. Now suddenly, you're supposed to sit still for nearly an hour while a single candle develops. Every instinct screams that you're being lazy, unproductive, that real traders are out there grinding while you're doing nothing. This is the exact moment where amateurs self-destruct. They panic in the silence. They start finding ways to fill the void, convincing themselves they need to stay engaged with the market. First comes the harmless distraction, checking Twitter for market sentiment, scanning financial news for catalysts that don't matter. Then comes the dangerous rationalization. I'll just take a quick look at the 5-minute chart to see what's happening in real time. That quick look becomes a stare. That stare becomes analysis. That analysis becomes a trade that violates every principle you committed to following. You tell yourself you're just scalping something small while waiting for the hourly signal. But now your attention is split. You're emotionally invested in a noise trade, while the high probability setup you were supposed to be patiently waiting for develops in the background. By the time the 1-hour candle closes and confirms your original thesis, you're already managing a loser from a time frame you promised yourself you'd ignore. You didn't fail because the system was flawed. You failed because you couldn't handle 43 minutes of boredom. But here's the truth that will transform your relationship with trading. The silence is where money is made. Those boring 45 minutes between decisions aren't wasted time. They are your edge, working for you. While you wait, the market is doing the heavy lifting. Institutions are positioning methodically. Weak hands are shaking out of premature entries. Stop orders are triggering and clearing levels. Liquidity is forming at key prices. All of this structural development happens whether you watch every tick or step away from the screen entirely. Your job isn't to add noise to that process. Your job is to preserve your most valuable resource, mental capital, so that when the moment of truth arrives, when the candle closes and your criteria align, you are calm, clear, and ready to execute without hesitation. Remember our opening revelation. You thought watching the market closer gave you more control. You believed that constant monitoring somehow translated to better results. Now you know the opposite is true. Distance gives clarity. Space provides perspective. By stepping back to the 1-hour chart, you've aligned yourself with institutional money, filtered out 80% of false signals, and positioned yourself to trade with the current instead of fighting every ripple on the surface. But all of that advantage evaporates if you cannot master the psychological challenge of productive waiting. Here is your complete professional protocol, the systematic framework that transforms silence from enemy into ally. These 6 principles work together as an integrated system. Remove any element and the entire structure becomes vulnerable to your worst impulses. Filter the noise aggressively. Make a definitive decision to ignore 1-minute and 5-minute charts completely. Don't keep them open for context. Don't peek during slow periods. Don't convince yourself you're gathering useful information. If those time frames are easily accessible, you will click on them during moments of weakness. Physically remove them from your workspace. Delete the tabs, close the windows, create friction between yourself and the noise that used to hypnotize you. Wait for the close without exception. Never enter a trade until the 1-hour candle officially closes. No early entries to get better prices. No exceptions for setups that look obvious. The final 15 minutes of any hourly candle can completely invalidate the first 45 minutes of price action. Use that waiting time, not to panic, but to prepare. Calculate your exact risk. Double-check daily trend alignment. Rehearse your execution so that when confirmation arrives, you're implementing a plan, not improvising under pressure. Align with daily trend direction. Every 1-hour setup must match the institutional flow revealed by the daily chart. This simple filter keeps you on the same side as big money and eliminates half your potential trades, the half that fight against dominant pressure. When daily and hourly agree, you have maximum edge. When they conflict, you have maximum risk. Choose your battles wisely by only fighting when the odds are genuinely in your favor. Size for swings, not scalps. Accept that 1-hour stops are wider and reduce position size proportionally to maintain identical dollar risk. Stop obsessing over share counts and start focusing on point capture. You're trading fewer shares for substantially larger moves. The mathematics favor this approach if you have the patience to let the process work instead of forcing quick profits that cap your upside. Pyramid into strength systematically. Use waiting periods to plan your additions. Instead of worrying about your entry, ask yourself, if this trade works, where do I add more? Mark the next logical support level. Calculate risk for a second unit. Transform from a nervous operator managing single positions into a strategic general planning campaigns that capture full trends. Embrace silence as productive time. The waiting isn't empty. Use it to review your trading journal, analyze past decisions, or simply step away from screens entirely. The market doesn't need you to watch it in order to move properly. In fact, it usually develops better structure when you're not staring at every minor fluctuation, second-guessing your analysis, or inventing reasons to interfere with your own plan. Students who implement this complete system report transformation that extends far beyond trading results. Trade frequency typically drops by 60 to 70%. They stop churning their accounts with marginal setups. Win rate improves by 15 to 25% because they're only taking high-conviction trades backed by structure and confirmation. Average win size increases by 200 to 400% because they're capturing real swings instead of scalping for pennies. But the most important change is one that doesn't show up on brokerage statements: an 80% reduction in stress and decision fatigue. They sleep better. Their relationships improve. They actually enjoy trading again, because it's no longer a constant battle against their own psychology. The 1-hour chart provides the discipline their amateur self lacked by making discipline easier rather than requiring superhuman willpower. Jesse Livermore understood this principle over a century ago when he said his fortune came from sitting tight, not from constant activity. The 1-hour chart forces you to sit tight for at least 60 minutes at a time. It's a mandatory cooling-off period for your emotions. It's a circuit breaker that prevents revenge trading, overtrading, and impulsive decisions made in the heat of the moment. Every candle becomes a natural pause that protects you from your own worst instincts. The final distinction that governs everything we've covered is this: the amateur needs action. The professional needs discipline. The 1-hour chart provides the discipline your amateur self lacks. Your amateur identity is addicted to stimulation and measures success by activity rather than results. Your professional identity understands that most of the time, the right action is no action, and measures success by following process regardless of short-term outcomes. The silence between candles isn't the absence of trading, it's the presence of discipline. And discipline, compounded over time, is what transforms scattered amateurs into professionals who survive long enough to see what patience can truly earn. If this shifted how you see time frames, if you're beginning to understand that less activity can genuinely produce more profit, your next step is mastering the specific price patterns that signal massive institutional accumulation. The next video on volume accumulation patterns on the 1-hour chart will show you exactly what to look for during those 60-minute waiting periods. You'll learn to identify the subtle footprints of smart money building positions methodically, the early warning signs of distribution, and how to position yourself on the right side of these massive capital flows before the rest of the world recognizes what's happening. For now, commit to these principles completely. Size small so individual trades cannot destroy your account. Wait for confirmation so you're responding to reality rather than predicting fantasy. Trust the process especially when it feels slow, because that slowness is your edge. Own your edge by protecting it from your own impulses to interfere. The market will always be there tomorrow. The opportunities will keep coming. Your job isn't to catch every move. Your job is to be positioned correctly for the moves that matter, with enough capital and mental clarity remaining to execute properly when they arrive.